Hello and welcome to Bazaar Morning Call. We're coming to you live from the Motilal Oswal CNBC-TV18 studios. I'm Prashant. With me, my colleagues Sonia and Nigel. And, we're beaming, we're smiling. It's a Friday. Good morning, guys.
Good morning.
It's been a grinding week, right? But it's coming to a close and things are looking better.
And it's Friday the 13th, huh?
Oh, yeah, it's Friday the 13th.
Generally, things don't really pan out that well on Friday the 13th, right?
But this time it's going to be good.
We break the cycle.
It's going to be a good Friday personally as well as for the markets.
Absolutely. Well, let's keep our fingers crossed and let's hope that it's been tough. Last more than a few trading sessions has been tough. Let's hope this is a little better. And it looks like it could be better, right? So what do we have? Let's just start from the very beginning. We got big reactions from US market overnight. When I say big reaction, I mean two specific markets. One is the rates market. US 10-year yields, this is market interest rates, they were down 10 basis points. That's huge, right? Big. Now we're at about 3.44 or so. The dollar index is now dropped another almost a full 1%. It's 102 and change. So there is a continuous drop in the dollar as well, which is at some point, I mean, there will be the accumulated impact which will start to show up. So far, it has not. On equities, it's, I would say mixed. It's positive. I mean, the Nasdaq was up 0.6, the S&P was up 1/3%. But could it have been bigger compared to the reactions we've seen in the dollar and the yields? I would have thought so, but it was not. Maybe the market is already starting to get a little thoughtful about the second-order impact of slowing inflation, which is, a consequence of slower growth, and growth matters for equities more than it matters for the other two things that I spoke about. In any case, the CPI number yesterday, and I think the debate will go on. Many are saying that this is not soft enough, and if you look at the underlying print, it still could be high going forward, etc. But I think for now we can all agree that this is enough to keep the peak CPI, peak Fed rate narrative intact. I'm calling it narrative because we need a few more data points to prove this, to kind of have this as a settled issue. So I think that is the good news right now, that nobody's now really going to jump and say, another 50 basis points in Feb, another 50 basis, that is done. Mostly it's 25 in Feb and 25 for how many ever there are left through the course of this year. So that is, I think, the positive out of the data point. Here in India, yesterday, the Nifty broke below the December low of 17,774, but it closed well above it, right? We saw a very large bounce and we closed well above it. You need a positive close today. Most definitely you need a positive close today. That will, I think, give a signal that the market is trying to negate the downside, the downward trend that we've been seeing. So a big bar from the lows to the high. And then if you get a positive close today, I think that is good news, technically speaking, just price action wise. On the downside, those same levels, which is the December low and then yesterday's low, which was just 15 points below the December low, 17,774, 17,761, I think should hold. That's the level to watch on the downside if selling comes again. On the way up, the 20-day moving average on the Nifty stands at 18,093. And above that, if you're able to cross that, you've got the recent high, which is Jan 9th, which comes in at 18,141. They seem far and seems unattainable given the price action recently. But the market gets a little bit of mojo back and it's entirely possible. These are not very sort of large, big levels we're talking about. This is near term. The Bank Nifty bounced yesterday without breaking yesterday's low. So actually it did better than what the Nifty did yesterday. The big support for the Bank Nifty comes in at 41,569, which is its December lows, 26th of December low for the Bank Nifty, which still holds. On the 20-day for the Bank Nifty on the upside is 42,728. That's the first number to take out. And above that, you get the recent high, which was made on the 4th of Jan for the Bank Nifty. That is at 43,578. Again, these are all very near-term levels, but I think these are important markers that the market should take out on the upside, and kind of these lows that we've had for the last, 2 or 3 weeks, all the way from the late December month. I think those should hold. I think that would be good as we wrap this week up. Guys, hi, morning.
Hi, morning. Absolutely. And, there are plenty of positive cues, right? And that's why we begin by saying that perhaps Friday the 13th may not be too bad for the bulls, because there are more positive than negative cues this morning. In local cues, of course, all eyes will be on the tech stocks. And we had some good numbers coming through from the likes of Infosys, HCL Tech, better than what the street was estimating. Cyient delivered a very good set of numbers as well. And the big positive, of course, from an Infosys standpoint is that amidst all of these challenges, they went ahead and scaled up their guidance. So, earlier the guidance was about 15 to 16% on the revenue front. Now that's been revised higher. I went through the conference call highlights as well, and in that they do highlight that there are cost pressures, there are economic concerns, and that is hitting the client side. It's impacting discretionary spends, but amidst all of that, they are standing tall and hence revising their guidance. So I think the street will give it 2 thumbs up. HCL Tech, after that mid-quarter scaling down of guidance, actually outperformed, reported a beat on revenues and on margins, so the street would like that. And it was a really strong quarter from Cyient as well. So after these 3 companies, I'm looking forward to names like Wipro that come out post-market hours today. There's Persistent Systems as well. So the entire IT pack could stand tall today. The other positive is that FI selling has reduced quite a bit. So yesterday there was just about 1,600 crores of selling compared to an average of 2,500-3,000 crores that we've seen in the last many days. DI has bought about 2,100 crores or so. And it was a strong global handover, as Prashant was just mentioning. Cooling off of inflation, positive local cues could aid the market. In fact, talking about our inflation, our own inflation, the Indian market inflation was also pretty good. Retail inflation cooled off to a 12-month low. The IIP data has gone up. And the Nasdaq, by the way, is up for 5 straight days. So we have more positives than negatives. The big question for me is, will this 17,800 level provide a good support, a good floor for the market, considering that we have positive data points? But what are the F&O cues indicating?
Well, Sonia, one factor that I want to highlight from the global cues is the dollar index. That's cooled off to around 102, and from an emerging market standpoint, that's a positive reading. So let's see how that plays out, because India has been relatively underperforming just for a couple of weeks or so. Yesterday, the weekly expiry came to the bulls' rescue yet again. Last Thursday as well, we had a 100-point recovery from the lows, and this time as well, it was no different. The Nifty Bank, it seems to be struggling to find its form. Nimish was telling us a hedge fund is selling some part of what they have, and maybe, a couple of funds are offloading out there. So that's what's causing the underperformance. The hope is that gets absorbed, and then we look ahead from there. For me, the positive, though, was the mid-cap and the small-cap indices. Everyone was fixated on what's going on with the Nifty, but the mid-cap and the small-cap, in fact, the small-cap almost ended in the green. So that's pretty good news. Foreign flows, well, our flows were a little bit skewed because of a couple of large trades. But the FI's return to China is quite startling, because we are just a couple of weeks into the year, and they've almost bought close to around 50% of what they bought in the past year. Remember, December, we saw a big flow towards China. And so far in 2023, well, they bought close to around half of what they did in the entire year. Let's see how that pans out, because the Indian markets, the FIs have been selling. The FIs on the F&O market here in India, well, they added some short positioning. This is not a bad thing. Short positions move to around 62%, or if they don't get the follow-through, they're going to be trapped on the wrong side. The question is, which way of 17,900 will it swing? Because the 17,900 call as well as the 17,900 put, both of them were very, very active. So I'm just plugging in the numbers out there. 17,900, you add close to around 300, 350 points out there. So the broad range you're looking at is a 400-point range. Downside 17,750, and we're closer to that level. But if we can get a relief rally, maybe we go back to around that 18,150 odd mark. Evidence indicates you buy in that zone, you make some money. So I think you better stick to that. And buy the dip today will be a better strategy rather than chasing that morning opening. 35-point bump up, 40-point bump up, I think that gets sold into at some point of time. Infosys has around 7% weightage on the index. That's going to bat for the bulls. But what happens to the Nifty Bank will be important. Buying the dip, a more prudent strategy than chasing this open. What else, Prashant?
Well, Nigel, thanks very much for that. That actually has always worked, which is don't chase right out of the gates, unless, of course, you've been in a very strong, bullish, trending kind of a market on the way up. And of course, in a strong bear market on the way down, which is not where we are in. This is more consolidatory, so as to speak. Sonia,
I just want to mention one thing. Tomorrow you have HDFC Bank's numbers. So, this is, of course, the last trading day when you can trade into that bank. And as Nigel was also pointing out now, the bank Nifty assumes importance. Ahead of that, does HDFC Bank see buying? Because the expectation is that the numbers will be good from the private banking space. So just want to put that cue on board as well.
Oh, absolutely. That's a big one. Well, before we go any further, let's quickly run you through what is lined up here in the first hour of the show. We will get you updates from markets across the globe. Mark Matthews of Bank Julius Baer will join us to discuss the global trade setup. Later, our research team will bring you CNBC-TV18's list of top 10 stocks for the day. And at around 8:30 a.m., we'll do a fundamental market analysis with Anand Tandon, who will be with us as always.
All right, let's do one thing. Let's get you some market talk now. On the equity side, we have Chris Wood of Jefferies giving us his view. He says meetings in London this week, primarily with Asian and emerging market specialist investors, reveal a growing optimism that emerging markets can decouple in a year that is likely to bring a US recession. He says there is a related optimism which greed and fear shares that commodities can decouple from a US downturn, a point highlighted by the rise in copper prices in recent days. He also says the copper price rise has risen. The copper prices have risen by over 12% since January and is up 32% from the lows reached last July.
Well, let's get you some money market views. Bhaskar Panda of HDFC Bank says US inflation is easing as the latest data shows, but labor market still remains tight. He says Fed watchers are now predicting a 25 basis point hike in the FOMC Fed meeting. As a result, he says the dollar index fell further, but oil has rallied on hopes of Asian economic recovery, especially better news coming out of China. This should add to positive sentiment that persists in the Indian currency. He expects a gap down opening for the dollar INR pair, and it could trade in a range of between 81.1 to 81.35 to the dollar for the day.
All right, and on the bonds, Bhaskar Panda says Indian CPI reading came within RBI's policy band, which is comforting for bond yields. Hence, he expects Indian benchmark yields to have a downward bias. He says the 10-year benchmark bond yield is likely to trade in a range between 7.2 to 7.3% today.
Well, we have a lot of stocks to track for you today, and we'll get to our special top 10 segment in just a bit. But let's run you through the list. We have Infosys, HCL Tech, Anand Rathi Wealth, BCL Industries, Lupin Cipla, and Natco Pharma. They are stocks on the back of positive news flow, while a few stocks like Paytm, Shriram Finance, L&T Tech, well, they are stocks that could react to negative news flow.
Mark Matthews is now joining us of Bank Julius Baer and Company. Mark, great to have you with us here. You know, the price action in the rates market and the dollar were much bigger, right, as compared to what we saw in equities. You wanted your thoughts. I mean, do you see it that way? And because, you know, inflation coming off is going to be a function of the economy slowing a little bit. So growth tapers off a bit, hopefully not very much, but that's got a sort of reaction function for equities. Your sense, Mark?
My sense, Prashant, is that the thing that will prove to be the big surprise this year is that rates will not go as high as the consensus expects, and that will be very beneficial for markets. So the inflation reading yesterday for the month of December was in line with expectations, no surprise there. But if we just continue to average the sequential change in the headline CPI for the next few months, which is 0.1% month on month. That's what it was in December. That's what it was in November. Let's say we continue to average that 0.1% month on month over the next few months. I don't see why we shouldn't, by the way, because commodity prices are generally either flat or soft, and the services are starting to peak in the PMI. Anyway, we would get on a year-on-year basis a headline CPI of about 3.5% by May. And therefore, I think there's no more need to raise rates even now. And our view is the last rate hike was in December. That is a non-consensus call, I know. But if we are right, and I think it's sensible to think that, then rates are being priced too high. And of course, the market would react positively if that proves to be the case.
Mark, good morning, and as always, it's great having you on the channel and speaking to you this morning. What about India? There are a lot of positive cues coming in for India. For one, the tech earnings from the big tech companies is not as bad as what perhaps the market has feared. FII selling has reduced quite a bit this morning. India's retail inflation has also fallen to a 12-month low. Is the case being built for more money to be put to work here in the Indian markets, or are you cautious?
I'm not cautious, but the most important thing that's happened over the past month is the reopening of China. And if I had to give it a score from 1 to 10, I'd give it a 15. It's far in excess of the most wildly optimistic forecasts a month ago. They've literally got rid of everything. And not just the COVID controls, but they're buying coal from Australia again. They're doing lots of things to help their property sector. They have gotten rid of the wolf warriors, the very belligerent people in the foreign ministry who caused so much damage to China's relations with other countries over the last 5-6 years. So it's all happened, and I think that means that China is very much back on the radar. And that means that India is simply not the first place that an investor in New York or London will look to. Now, I still like India. The things that you mentioned are absolutely correct. But I think it's locals who will continue to take the market up in India, just as they did last year.
All right. Hi, Mark. Morning. But, it's getting a little bit worrying. And as you said, China's reopening has played out much better. I'm looking at a Reuters report, and they are suggesting that the flows you've seen the first couple of weeks is nearly 45% of what the FI flows moved into China in the entire of 2022. In this sort of a backdrop, do you expect the Indian market to see some selling pressure? If they are going to take some money off, do you believe we can see a bit of a correction here?
No, because I don't think foreigners are particularly big in India in the first place. They have been consistent sellers of India for several years, and you would know the data better than me, Nigel, whether they turned buyers over the last few months of the last year. I don't personally know, but foreigners are not overweight India in any meaningful way. And so why would they take chips off the table? If anything, I was eavesdropping on your earlier conversation where you were quoting Chris Wood at Jeffrey. If the U.S. has fairly, moribund GDP growth this year, and we ourselves were only looking for 0.7% GDP growth there, and earnings growth is, let's say, mid single digit. Whereas in India, we're looking for over 20%. And so his point was that emerging markets can decouple, and I agree. And so in that scenario, why would you sell your India? It wouldn't make sense.
And I think the other point many have made is that, in the short term aside, in the longer run, China coming back in a big way and being being kind of a market which attracts a lot of foreign capital is positive, because most of the money we get is through these emerging market funds, right? And India is a part of it. So you get a share of whatever comes into these funds. Tactically, maybe near term, there is some reallocation and stuff like that. But longer term, China really fully coming back in a big way to the global economy, global markets is positive. Would you agree, Mark?
Yes, I would. But I would also say they're radically different markets. And as much as good things are happening in China, common prosperity has not gone away. It is an environment which will continue to weigh heavily on the private sector, I think, over the long term. Now they're giving the private sector some leeway because they need to get the economy going again. But it's not the China that we knew 10, 20, 30 years ago. It has changed for the worse as far as the market goes. Common prosperity, right? India doesn't have that. I mean, India has populism, of course, but the government is staunchly pro-capitalist, pro-markets. So I'll just give you an interesting statistic. Over the last 30 years, India returned 9% per year in dollars, including dividends. China returned less than 1%. And past returns are not indicative of future returns. But I suspect that India's performance in the future will still significantly outweigh China's. I'm not talking the next 6 months, but I'm talking, the next 6 years.
All right. Well, you don't know what's going to happen in the next 6 hours these days, right? Forget about the next 6 months or the next 6 years. Mark, it was a pleasure speaking with you. Thanks a lot for joining us on CNBC-TV18. Well, let's do one thing. Let us take a quick break. On the other side, lots of macro and micro data to analyze, so don't go anywhere. Our entire team will be with us. Stay tuned. Welcome back to Bazaar Morning Call. There's so much to talk about this morning. So without wasting any time, first, let's drill it down to the macros. Inflation in India eased in December to 5.7%. That's a 12-month low. So retail inflation now at a 12-month low. A sharp drop in food inflation led by a fall in vegetable prices kept it below the RBI 6% threshold for the second month running, while the industrial output in November accelerated to 7%. So good news all around. Lata's here to tell us all you need to know about the numbers. Lata, over to you.
It is a very good inflation number, and it's not just this 5.72 of December. compared to the 5.8485 that everyone was expecting. It's also that if you look at the October, November, December average, it now works to 6.1. The Reserve Bank was expecting 6.6. So it means it's consistently come below the Reserve Bank expectations for all the 3 months. Food, as you said, was the clear winner, coming in at 4.19 or 4.2. Last month, it was 4.67. Veggies fell more than expected, and that countered the minor rise in cereals and milk. Now, the fly in the ointment is going to be the core inflation. That's still at 6.1, and the Reserve Bank specifically made mention of that in their statement in December, that they worry that that has to ebb. So that perhaps is the only worry. But the economists we spoke to, most of them have lowered their rate hike expectation. This is not a poll, it's just a dipstick survey. But many people who were expecting 2 more hikes have now lowered it to 1. Many people who were expecting 1 have now lowered it to a pause. And, wait and see. So this is going to have an impact on bond prices and, most importantly, for stock markets, on NBFCs. All these days, because of the rate hikes, banks with cheap money were actually benefiting from the rate hikes because their margins expanded. NBFCs got the rough end of the stick because they were borrowing from the banks. Now, if rates don't rise anymore, the so far ignored NBFCs, to some extent even Bajaj Finance, but Chola, Sundaram, Shriram, Poonawalla, all of them could have an advantage because the cost of money is not going to rise. I think for me the bigger surprise is the IIP number. It's an ignored number because many people believe it's not properly collected. But, this number is very good, and it's good on, everything. Power, 12.1%. The core sector gave us a very different picture. Now, it completely alters. Manufacturing, 6.1, very good, again, not expected. Mining, 9.7, but more important, the use-based classification. Consumer non-durables coming in at 8.9. Remember what Bajaj Electricals told us? Remember so many people telling us that rural consumption is weak? 8.9 consumer non-durables, FMCG goods. This should not be ignored. Consumer durables, again, 5.1, but I think the auto sales were anyway pointing in that direction. Capital goods, 20%. These are from smaller bases. But I think the consumer non-durables is giving an important picture that consumption is not as weak as some companies at least told us. So my sense is this should have a positive impact on the stock markets, especially on FMCG and consumer sectors.
Okay, all right, Lata, thanks a lot for that. We'll keep an eye out on those couple of sectors, but let's drill it down to a couple of stocks then. We have our research team that's standing by with CNBC-TV18's top list of stocks for the day. Well, Rima, you're tracking the big ones. You go first. Infosys and HCL Tech.
Well, the key takeaway from the IT earnings is now HCL Tech, Infosys, TCS, all 3 of them have reported a revenue beat. In fact, for HCL Tech, it's not just a revenue beat, but it's a margin beat as well. So HCL Tech strong, revenue and margin beat, while for Infosys, it's a revenue beat, but a margin miss. So if you stack up the numbers, you would see that all the 3 IT companies have reported a constant currency year-on-year revenue growth of more than 13%. In terms of topping the charts, it's HCL Tech, the highest at 5%, while Infosys constant currency revenue growth at 2.4% was ahead of TCS. Both Infi and TCS had missed the mark on margins. For Infosys, the margins were flat on a quarter-on-quarter basis, but HCL Tech's margins expanded by 165 basis points, coming in ahead of expectations. For Infosys, the big positive was the FY23 revenue guidance has been upgraded to 16 to 16.5%, and the deal wins were the best that we've seen in the last 8 quarters. For HCL Tech, the beat was driven by a seasonal strength in their software business, which is also called the products business. That will moderate in Q4, which is why the company has not changed its guidance. They've just narrowed it down. Now they're saying FY23 revenue growth will be between 13.5% to 14%, and the deal wins are flat for HCL Tech.
Okay, all right. Thanks a lot for that, Rima. Another point, overnight, Cognizant, they revised their guidance and they also appointed a new CEO, Ravi Kumar, who held various portfolios at Infosys for close to around 20 years. So that one, in fact, was up close to around 6% overnight. Let's see whether or not the IT stocks can lead the way today. Well, let's move on to the next couple of stocks that are news. Well, Nimesh is joining us to tell us about Paytm. Large trade yesterday, Nimesh. You gave us some bit of a sense. What's your reading now?
Hi, Nigel. So there are 2 bits of news on Paytm to track today morning. One, of course, the big confirmation that Alibaba has sold a big chunk. So they've sold 1.9 crore shares. equivalent to 3% at an average price of 536. In terms of buyers, there are the names like Morgan Stanley Asia, which is a P-note, and Gasilo Master Fund. They were the big buyers in yesterday's block deal. Remember, Ant Financial, which is Alibaba's arm, they own close to 25% stake, so the supply overhang can continue in Paytm. Also, remember, in November, SoftBank sold close to 4.5% stake, and their lockup will open in the next few days. So there could be further threat of SoftBank selling the further stake. So that could be a further overhang on Paytm. On the other side, there was an official disclosure from the management of Paytm that they've bought some shares in the buyback. So yesterday they bought close to 19 lakh shares at an average price of 454. And until yesterday, which is 12th of January, they've cumulatively acquired close to 70 lakh shares in the buyback. So, while there is a buyback support from the management, there is supply overhang which can keep the stock in pressure, and that's why I'll go with red in the morning.
All right, thanks a lot for that. So going with red on Paytm, let's move on. Abhishek is joining in. He's going to tell us why Shriram Finance could be in focus this morning. Abhishek, good morning.
Good morning, Sonia. So, Shriram Finance could be under pressure today as PE fund Apex Partners plans to sell shares via block deal. So, Apex Armed Dynasty Acquisition will sell about 1.98 crore shares or up to 5.3% stake in the company. They will offer a 1% discount on the deal. Kotak Securities and IIFL Securities are the brokers to the deal. Deal size on the upward is about 2,578 crores, while the base deal size is about 1,226 crores. So in 2015, Apex had bought shares in Shriram City Union Finance, and post the merger in Shriram Finance, they have shares which will be sold in trade today. Back to you.
All right. Thanks very much for that. 1312 is where the stock closed yesterday. Now back to technology, and LDT Tech is the next one that we are talking about. Arima, back to you.
Thanks so much for that. So LDT Tech has agreed to acquire Smart World and Communication business of its parent company Larsen & Toubro. With this, LTTS will be able to expand its offerings in next-gen communication, sustainable spaces and cybersecurity. But remember, this is a related party transaction, and a material one. Now, about the financials of this transaction, the company LTTS will be paying 800 crore rupees to L&T to acquire this business. But remember, LTTS has a lot of cash, close to about 2,400 crores as of Q2 end, September end. But so nearly 1/3 of the cash on LTTS books will be used to acquire this company. The acquired company's revenues are nearly 1,100 crore rupees, which is 16 to 17% of LTTS FY22 revenues, like to like. But there are some concerns which are flagged off by the analysts. One-third of the cash on LTTS books will be utilized for this intercompany, transaction. 2, the risk is margins of the acquired company could be lower because it's an India-based business, and a lot of the revenues come in from the government. Indian government appears to be a big client of SWC. So, those are some, issues which analysts have flagged off. But if you just purely look at the financials, they're paying 800 crore rupees for a company whose revenues are 1,100 crore rupees. So on the top line, the transaction value seems okay, but we need some clarity on what the margins are.
All right, thanks a lot for that. And of course, we'll be hearing from the management as well. Thanks, Rima. Let's go across to Surbhi now. She's tracking Anand Rathi Wealth. They came out with their Q3 numbers. Surbhi, how did it look?
Anand Rathi Wealth reported their Q3 numbers and they were pretty decent. Their revenues were up 1.4% sequentially at 138 crores. Their EBITDA went up by 2.2% at 62 crores. The margins remained constant at 44%. Now the AUM that went up by 7.5% at 38,500 crores. The number of relationship managers was up by 2% at 277. Their active client families that went up by 3%, but their net client additions that was down 39% at 274 versus 451 in the previous quarter. They have revised their FY23 guidance. They say that the AUM is now going to be 40,000 crores versus 39,000 crores previously. They're going to clock a revenue of 525 crores versus 495 crores and a PAT of 165 crores versus 155 crores.
Okay, thanks a lot for that, Surbhi. Well, Ekta's joining in as well to tell us about some more stocks in the news. Ekta?
Thanks for that. Well, I'll start with BCL, which is going to issue an allot around 55.8 lakh fully convertible warrants at 360 rupees per share, aggregating to 201 crores. Also, I'd be watching for a couple of these pharmaceutical stocks such as Lupin, Cipla, Natco, because the US federal government has released 52,000 courses of the flu antiviral Tamiflu from the national stockpile simply because of the shortage that they're facing because of the heavy flu season that they're seeing. So it could possibly be a rub-off, positive rub-off for a couple of these companies that manufacture the generic version of the drug.
All right. Thanks a lot, Ekta, for that. So we'll keep an eye out on these companies. But here's a quick recap in case you missed out on any of the stocks. Stocks with positive news flow this morning. There's Infosys, HCL Tech, Anand Rathi Wealth, BCL Industries, Lupin, Cipla and Natco Pharma. While stocks with negative news flow, there's Paytm, Shriram Finance and L&T Tech. But let's go across now to Manisha Gupta to find out what's the latest in the world of commodities. Manisha, good morning.
Morning, and the gains here have just about continued, whether it's about crude or gold or base metal prices, all of that is trading in the positive, and we look like we are heading for a weekly gain for many of these commodities. I'll start with the crude oil prices, where we are trading at a 2-week high. Prices have gained for a 6th session, and prices did gain 1% overnight. There are the U.S. inflation numbers coming in on the weaker side, really supporting the precious metal prices also. So you have gold prices now trading at an 8-month high, headed for a 4th weekly gain, and we are just inching close to that $1,900 per ounce mark. But very strong gains continuing in case of copper as well. This is the best weekly gain that we've seen in 2 months coming for copper prices also. Decline in inventories, decline in US dollar have been supportive factors here as well.
All right, Manisha, thanks very much for that. We'll, of course, keep coming back to you for what's happening on the commodity side. We'll take a break here. We are back with Anand Tandon, and there's lots to talk about, starting, of course, with the tech numbers, which we've got overnight, but so much more. Stay with us. Later, we also will have the management of Cyient, which reported numbers. Numbers came out, I think, the last hour of trade yesterday. So a discussion on the numbers and outlook going forward with the Cyient management.
Welcome back. Let's analyze some of those big numbers that came through overnight. Infosys, of course, tops the list, where the company has raised their revenue guidance up to 16 to 16.5% versus 15 to 16% earlier. Anand Tandon is joining in to analyze all this and more. Anand, good morning. You know, it's sort of an outperformance that perhaps we're expecting from a lot of these IT names now, considering that Infosys, HCL Tech and Cyient have reported good numbers. But is this a time to buy? Or would you want to still wait and watch a bit?
It depends on your overall view of the market as well. So from coming back to the numbers first, clearly the expectation of slowdown next year is still very much on the cards, right? I mean, even the managements are talking about the fact that they are seeing more cost takeout deals than actual growth kind of growth-oriented deals. The financial sector, etc., budgets are still not being finalized very easily and all of that, which essentially means that the expectation that the market already had going in was that this year will be quite okay, but next year there will be a slowdown, and that's why we have seen the stocks come off quite considerably. Now the question really is that valuations compared to the rest of the market, to my mind, in an absolute sense they are expensive, but on a relative sense they are not. So even if you are looking for a slowdown next year, and it is quite possible that if you want to be bullish on the market, then the slowdown can be constrained to perhaps the first half, and the second half can look a little better. You don't have particular reason to be moving out very sharply. It of course depends on what kind of numbers you actually get from the companies, but the expectation is single-digit kind of growth next year. As opposed to that, most of the companies are trading at 18 to 20 times forward earnings among the frontline companies. That makes it a little expensive. So I think it will be market performer, because where else will you be hiding anyway? You are looking at a situation where the market could be coming down a little more. So I don't expect strong underperformance right now, but we'll have to see how the quarterly results come through and we'll adjust our positions accordingly.
All right, Anand, stay with us. I just wanted your view on PVR as well. We broke the story yesterday that the PVR-Inox merger has got the NCLT approval, not a written order, but it's been given the go-ahead. Let's just revisit that story with Nimish. Nimish, hi.
Hi, Prashant. So, post-evening yesterday, there was a confirmation from Inox management that, yes, they have got an oral order from the NCLT Mumbai that the merger between PVR and Inox has been officially approved. Now, the written order is expected in the next 15 to 20 days. Post that, the process of the new entity will start, and that could get over in the next couple of months. In fact, if you look at the ratio, it's basically 3 shares of PVR for 10 shares of Inox. Now, the merged entity will be a force to reckon with an pan-India presence of more than 1,600 screens. The merged entity aims to add 200 screens per year. In terms of board representation, both the companies will have 2 members on the board. The Inox promoters will own close to 17% stake in the company, or 16.66 to be precise, and the PVR promoters will own 10.5% stake in the merged entity. The merged entity, after it comes into force, will have a 40% market share in the top 7 cities. So, the final hurdle or the big trigger for the stock is now out of the way, and the NCLT Mumbai has finally approved the merger between Inox and PVR last evening.
All right, thanks very much, Nimesh, for that. It's at an interesting juncture, the stock. I'll put out a chart a little later on Market Laser today on PVR, it had a bit of a breakdown and it's now coming back up. Yesterday, the stock finished about, 2.5% higher. Anand, what's your sense? The merger gets the go-ahead, but it's not as if there were grave doubts whether the merger will get a go-ahead or not, right? But of course, it's not done till it's done, and now it's closer to being done. Your sense?
Well, I don't see a problem with the merger per se. Both for the management of both the companies, it kind of makes sense to consolidate. As your analyst pointed out, it will make it a monolith, the dominant player in the sector, especially in multiplexes. There will still be a lot of single screen halls around, but at the end of the day, the highest value comes from the multiplexes. So from that point of view, with that kind of dominance, they'll be able to get better deals. But I think we have to realize that, and the market has shown us over the last few quarters, that what is important in the movie business is the movies. The content is king. It is not the place where you're showing that. And now with the OTT becoming a real threat in terms of an alternative, the kind of dominance and the kind of revenue growth that they were witnessing prior to the lockdown and COVID, I don't think you're likely to see that going forward. So I think, it's still, to my mind, not the best of places. What exactly are you playing for?
All right. Okay. We have the management of Sign, which will be with us in shortly, so it will bring them in. Anand, just a few other names, very briefly, if you can sort of touch upon. Divi's saw a large cut yesterday. Some of these things tend to see follow-through moves. Reliance has been particularly weak many sessions now. Your thoughts? Divi's and RIL.
I don't particularly track Divi's very closely, so I can't comment on that. Reliance, clearly that is a question about, again, to a large extent, how to play the various sectors that it is working in. Refineries, we all can see OMCs are losing money. Of course, Reliance doesn't have the same dynamics, but even then, the margins will be a little subdued compared to what they were earlier. Retail has been growing, but perhaps the valuations have caught up with it. Telecom, there is a better player, which is Bharti. Of course, Telecom, I think Reliance will continue to gain market share because Vodafone will continue to exit. So overall, at this point, I think Reliance is in a kind of hold territory, which essentially means that as an institutional player, you should be selling. But if you were to take a one-year view, I would argue again that you cannot. Anyway, the index forces you to be underweight, and therefore you have to be holding on to it, going forward.
Okay, very quickly, would you put more money in some of these private banks like HDFC Bank? The numbers come out tomorrow. Your expectations?
I think yes. For the next 2 quarters, at least, the frontline private sector bank should do quite well. But Axis Bank clearly looks like the best pick at this time.
Okay, all right. Just stay on. As Prashant was telling us, we are, of course, going to continue talking about the IT companies through the course of the day. And the first corporate on our radar is Cyient. The company reported a very strong performance in Q3. The dollar revenue surged nearly 13%, while the margins have expanded substantially. 10% was the margins in the previous quarter, and this quarter it's 13.2%. And another key positive, the deal pipeline also looks quite strong. There are 5 new large deals in the services segment. Krishna Bodanappu, the MD and CEO at Cyient, joins us now to talk about that. Mr. Bodanappu, good morning and congratulations on a good set of numbers. You've guided for Q4 to be better than Q3. Can you tell us how much better can Q4 be, considering that the environment is quite challenging? We are perhaps heading into a US recession as well. In Q3, your constant currency revenues were up about 3.5% quarter on quarter. What is the outlook for Q4?
So good morning and thank you for having me on the show this morning. So we're seeing some good traction in the industries that we're in. I think one of the good things that's happening for us right now is the aerospace industry, which is a large part of our business, is actually coming back quite strongly because of the various dynamics that are involved there, including air traffic on the civilian side, military spend on the defense side, and so on and so forth. So taking all that into account, we're seeing that there isn't any material issue in demand, at least in the industries that we're working in. Of course, there are certain industries like semiconductor which are slowing down a little bit, and we just will mitigate against that. But some of our large industries are doing quite well. Therefore, from a demand perspective, at least that 3.5% number that you mentioned, we see at least that demand. We will see acceleration of that. We'll actually see meaningful acceleration of that. We're trying to figure out what is the right balance for us, because we also don't want to overstaff and then have to take some decisions, or also we want to look at this as an opportunity to clean up some of the non-profitable customers, etc. That's why we're a bit cautious, but the demand is there and we'll definitely do better than what we did in Q3.
Okay, quarter 4 will be better than quarter 3. Well, the street will like that quite a bit. Krishna, well, give us a couple of more numbers then. You've been talking about going to that run rate of $1 billion. When does it happen? In quarter 3 or quarter 4 of FY24? And the bright spot in your numbers is the margin improvement. How much of that was because of the rupee depreciation? And you've also been telling us that it will gradually improve from here on. What's the targeted number on the margin front?
I think margins, we've done a lot of work on that, and there were a lot of both operational inefficiencies and also overheads, that's between the gross margin and the EBIT line, that we were able to really address over a period of time, and that will continue over a period of time. So while the rupee benefited, or the currency benefited somewhat, but it was marginal, it was maybe 30 or 40 basis points, or actually 30 basis points or so, was because of the currency. But the rest of it was because of operational improvements and operational efficiencies. Our target is to get to at least the mid-cap average to start with. And within the next financial year, we have a line of sight of getting there, because we're still taking on a lot of costs, because things like leases, etc., also have a cost associated with them when you walk away from a long-term lease. We're taking them all in the right sort of balance, those decisions. But we're quite confident that within the next year, we'll at least get to the mid-cap average.
Okay, Krishna, good morning. For investors, IT is still a very much a macro kind of story, that at some point the growth in terms of the US growth will drop, and suddenly there could be deferments, etc. And we also constantly hear investors complain that IT company managements don't forewarn. Of course, I mean, to be fair, you can only say what you see. And that's absolutely fine. But is there any risk of any of this that I kind of described happening, in your opinion, that suddenly things go south and we have these deferments, etc., sometime later in 2023?
See, I mean, honestly, with risk, never say never. So I would say there is that risk, but I also feel that if you look at why things are changing so much and the acceleration that the IT services and the technology services companies have seen, it's because the adoption of technology, right? I mean, there's so many things that are happening where people are using technology that much more. I mean, even simple things like even in our day-to-day life, from using going physically to using a computer to using a mobile, that's the transition that's happening today, and you can extrapolate that to industrial and connectivity and so on and so forth. So in that sense, I think there is a bit of a buffer, if I may say, because fundamentally behaviors are changing, fundamentally how people are designing and creating products are changing, and that's what's driving the growth in the engineering space. So, I mean, that risk always is there, because if the economy goes very sour very quickly, then of course, that's also the challenge of technology, right? Because technology adoption is quite quick, and also, when things go sour, people do cut back on technology. That risk is there. But I feel this time there's also a better mitigation because of the adoption of technology and the global imperative that these things have to happen quickly. Otherwise, companies will fall behind. And once they fall behind, there's a very significant catch up. So I think there's, at least in the engineering space, I think some of it is mitigated because of just the technology curve.
Okay, all right. We have many more questions, but unfortunately, we don't have too much time. We will leave this for another day. All the best. Thanks a lot for joining us on CNBC-TV18. Okay, that's Science saying that there's good traction across various industries, especially the aerospace industry is coming back in a big way. Before we take a break, let me tell you what's lined up in the next half hour of the show. We'll bring you the top stock picks for the day from our technical and F&O experts in just a while from now. After that, we will have the Market Laser segment by Prashant, a segment where we analyze stocks and sectors through a technical lens. Later, we will decode the stock rally in our Momentumizer segment, so do stay tuned in for that. At 9:10, Nimesh will be there with the standout brokerage report of the day. And before the market opens on our CNBC-TV18 stock board, we will highlight all the top stocks in the news to focus on for the day. So lots coming up. Do stay tuned in.
All right, welcome back. We're just running into market opening, 10 minutes away, and Anuj is here in the studios to run us through the trade setup. Anuj, but first of all, many congratulations. It's birthday day for CNBC Awaaz.
It's birthday day. It's 18th birthday for CNBC Awaaz, and I'll tell you the biggest skew for the market. In last 8 out of 10 years on our birthday, market's been on green.
Oh, wow.
So, and 3 out of last 3 years, we have been in green. The market has been in green. So,
taking a cue from that.
So we'll take a cue from that.
Wishing Awaaz a very, very happy birthday. And when's the cake coming, the big party?
The cake's there at 3 o'clock. You're all welcome to join. Today at
Absolutely.
3 p.m. in the newsroom. We will be live with the cake cutting ceremony, and all of you are welcome to join.
Yeah.
Thank you. So, but let's talk about the market, because what I focus on is price action. Data is very positive today. If you look at US data, inflation is good. India, IIP and inflation both good. Infosys, guidance raised, but the Indian market has been selling off for some reasons and not following the global cues. And if today we see a sell-off, I think the market will become very weak. Just a very interesting blog I read in the morning about how the US market is seeing inflation and how Fed sees it. The market believes the inflation is was a problem of 2022, and that's why it's really cheering almost every day. Nasdaq, in fact, has rallied 10% from the lows, and it has significance because Nifty IT this week is up 2.7%. It's showing signs of bottoming out once again, and there's big risk on rally in commodities. So my sense is IT plus metals is really going to be the theme, at least up until budget. On the Nifty, yesterday we broke the December lows, but bounced back, but it's shown signs of breaking down, and perhaps the 200-day moving average has now opened up, which is 17,300. The declining 20-day moving average is now at 18,093. The bigger problem is Bank Nifty, which is no longer the leader for the market, at least going by the recent evidence, and has now become sell on rally, especially because ICICI Bank has weakened and is now testing its 200-day moving average. So that's the setup as I see it.
Right, Anuj, thanks very much for that. So that's basically the trading setup. Today's close after yesterday's drop and then recovery, today's price action will matter more. And if you have a positive close, a good close, I think it negates some of the pessimistic price action we've seen recently. But will we see that? Mitesh is with us, and so is Srikanth for technical trading ideas. Gentlemen, good morning. Great to have you this Friday morning. Mitesh, to you first on the index. What is your sense?
Good morning, Prashant. I think, we are not yet out of the woods in the sense that, one, we've kind of held on to 17,800, not giving an hourly close below that. But any signs of reversals are yet to materialize. I think once we start getting past 18,000, then, a test of 18,150 and then 18,250 could happen. So we could get a trading bounce back. That is the best scenario, but that will also be confirmed once we start getting past 18,000. So the range has narrowed now to about 200 points for me, 17,800 on the downside to about 18,000 on the upside. And I think, as Anuj was also highlighting, correctly so, the Nifty Bank, I think that's, something which is added to the worry. It's turned slightly weak, but let's say 41,600, 41,800 is an important support pivot. If that holds on, and then Nifty Bank starts getting past 42,400, then I think, at least temporarily, that chart should also improve and add to the momentum on the upside. So for the time being, wait and watch, but let's see if 17,800 holds and then we get some kind of a reversal.
All right, thanks for that. Shrikant Chauhan is also with us. Shrikant, a lot of positive cues this morning. If the market does take, a cue from that and move up, at what point would you perhaps sell into it? What should the strategy be for the day? And while you're at it, give us the individual stock ideas as well.
Good morning, Sonia. Good morning, Prashant. Nigel. I think, the markets are clearly in the range, and even though there are specific positive news flow, we are not seeing any momentum or major gains for Singapore Nifty. It clearly shows that the market is waiting for something else. And that's the reason we need to follow the levels. I think 18,000 is the level where we should keep a close watch. And today, if we see the market is sustaining above the mark of 18,000 very confidently, then the next level to watch out for would be 18,300. Otherwise, we need to be careful around 18,000 levels after the opening. On the downside, 17,750 is certainly going to act as major support. Below that, we can expect further more decline towards 17,500 or 300 level. So 18,000 is the level where if there is any contra view, then they can take a contra trade of going short with a stop loss at 18,050.
Okay, all right. Gentlemen, request you to stay on. When we come back, we'll get the trading picks from our technical experts. We'll also get you pre-opening rates, and also we'll be joined by Manik Taneja of Axis Capital to discuss the Q3 numbers in the tech space. Stay with us.